Today we are going to learn how to read a balance sheet like an expert. A balance sheet shows a company's assets, liabilities, and equity. Assets on the left, liabilities and equity on the right. First, the balance sheet. It shows this shows if the business is profitable. And the cash flow statement tracks the movement of money. A balance sheet shows a company's financial position at a specific time. It balances assets, what is owned, with liabilities and equity. An income statement shows a company's financial performance. It details revenue, expenses, and the resulting net profit. Net profit equals revenue minus expenses. A cash flow statement shows how cash moves in and out of a company. It is divided into operating, investing, and financing activities. The accounting equation is assets equals liabilities plus equity. This equation must always balance. Let's see how. Assets are what a company owns. This includes cash, inventory of goods, and receivables, money owed to the business. Current assets are what a company owns and can turn into cash quickly. This includes cash, inventory, and money owed by customers. Non-current assets are long-term investments, like buildings and machinery. On the balance sheet, they are grouped separately from current assets. Liabilities are money the company owes. This includes bills, existing debt, and loan repayments. These are shown on our dashboard. Current liabilities are short-term obligations due within a year. They include accounts payable, short-term loans, and unpaid expenses. This is on the balance sheet. Long-term liabilities are obligations due after 1 year. They include long-term bank loans and debt agreements. This creates long-term financial responsibility. Shareholders' equity represents the owner's interest in a company. It's calculated as total assets minus total liabilities. This is shown here on the balance sheet. Retained earnings are profits kept in the business to fuel growth. Instead of paying them out, we reinvest. This chart shows how that drives growth. The current ratio measures short-term financial strength. Its current assets divided by current liabilities equals a ratio of 3.0. The debt-to-equity ratio is calculated by dividing total liabilities by shareholder risk by comparing its debt to its equity. Welcome to Balance Sheet Analysis. Let's review or show liquidity and debt relationships. This dashboard helps assess overall stability. Current assets are $50,000 and non-current assets are $1,000, totaling $200,000. Let's recap current and non-current assets, liabilities, equity, ratios, and analysis. Thanks for watching. For more accounting and finance lessons, like, share, and subscribe to FinCorp 360.